chambers of the EU, the European Parliament, and the Council of the European Union. This consultation is an obligation stemming from the Treaty on the Functioning of the European Union. The opinions of our committee are not binding, but help to make the EU legislative process closer to the citizens. Further to obligatory opinions it has to deliver, our committee can also draw up own initiative opinions, much in the same way that the European Parliament can do. If we find that a topic needs more attention in the current political debate, and that something should be done to address pending issues. We have a process, a formal process within the committee to open the floor for ideas to develop on this chapter of own initiative opinions. I am in particular, for instance, now drawing up an opinion on the health of the European financial system, which I think that needs some sort of tweaking and improvement. That doesn't mean that we are advocating for a relaxing of regulation, but what we are trying to do is to make sure that the regulation that is applied to the financial sector is fit for purpose. Very recently, the European Commission has implemented a new requirement for any new European legislative proposal that has to do with what it is called a competitiveness check, to make sure that the legislation that is implemented is fit for purpose and basically is able to get the real economy and the European industry up to speed and be able to compete at the global arena. So, against this background, during recent years, the European Economic and Social Committee has adopted numerous opinions in the policy field of financial markets, to a large extent on proposals for the EU directives or regulations. I hope, well, I am sure that I'm going to come back once the discussion is opened with my views that in some cases will not reflect the committee's views because in particular we haven't worked in detail on many opinions related to Brexit itself, although obviously we have worked in many opinions related to the financial sector. So for the time being, this is it from me, Federico. I hand over to you to start out our discussions. And let me reiterate again how pleased and happy I am to welcome you here. So thank you very much.
Thank you very much, Antonio, for opening up. And it's now my great pleasure to introduce the other participants to this panel and conversation. I'll introduce them in the order they are seated close to me. So I'll start off with Christian Petit, who is Assistant Professor of European Banking and Finance Law at Dublin City University and the Deputy Director of the Brexit Institute. Christy has degrees from the College of Europe and a PhD from the European University Institute. And as I mentioned, she is the prime rapporteur, the prime drafter of the report that was commissioned by the European Parliament Economic and Monetary Committee on Financial Services after Brexit. And she has published a significant number of publications in the field of European banking and finance, including in the Journal of European Integration and others. After Christy, or seated to the right of Christy, is Massimo Zaffiro, who is a senior official at the European Commission DG FISMA, where he currently leads the team in charge of EU-UK financial service regulatory cooperation. Massimo has degrees also from the College of Europe and Lewis University, and before joining the Commission spent time and worked at the ESMA, the European Securities and Market Authorities in Paris, so brings in the many years of experience as a regulator and now part of the EU executive. After Massimo, closing the table to my right is Andreas Heinzmann, who is a partner in the banking and capital market group of GSK Stockmann in Luxembourg. GSK is a German law firm that runs an important office in the city of Luxembourg, specializing in security laws, capital markets regulation, and international banking. As I mentioned earlier on, GSK has been supporting the Brexit Institute for many years, and we're very pleased of this cooperation that brings on board also the experience of Andreas in this area. He has been advising banks, financial institutions, and corporates on issues of debts and equity security, including stock exchange listing, securitization, repackaging, etc. But I should also mention Andreas has a long list of publications, including a chapter he wrote together with Valerio Scollo on the Research Handbook of European Union Economic Law, which I edited for Elgar Publishing with Marco Venturuzzo back in 2019. And then, definitely last but not least, I had previously semi-introduced you, Antonio, but also Antonio will be joining the panel and bringing in his expertise. And I had left out what I wanted to say about him, that he did work in 10 jurisdictions before joining the ESC. So that I didn't forget that. Having said that, I'll stop here in my introduction and immediately hand to Christy. I think each panelist will have roughly 10 minutes, possibly even less, for their remarks, and then we will have a round of discussions and exchange between the panelists, and then open up to the floor for questions and answer. We aim to close by 4:30 p.m. because it's a particular day in Brussels with the strike and everything, so we want to facilitate also the participants. So I'll stop here, and Christy, the floor is yours. Thanks.
Thank you very much, Federico. Thanks very much to the EESC for hosting us. Thanks a lot, Antonio, for your introduction. So here I will focus on the main findings of the report. So since the publication of the report back in February, and also since the discussion at the European Parliament at the end of last month, a number of changes happened. So I will not give credit to everything, but I want to highlight at least 3 evolutions before focusing on the findings of the report. The first one, and I'm sure you're aware, is the adoption of the Windsor framework in February following the settlement of the dispute over the Northern Ireland trading arrangements. And overall, this evolution favors and has favored already a spirit of mutual trust and cooperation. And here I'm quoting some of the wordings of the Commissioner McGuinness. And I think this is already happening in practice, because this has led already with the signature of the MOU on financial services. So Federico had alluded to that. Because it was put on hold for more than 2 years beforehand, at the expense of regulatory cooperation and at the expense of putting into place a joint forum between the EU and the UK. And the third evolution I want to mention is the fact that the UK's Trade Secretary lastly set out a new approach with some amendments to the currently debated retained EU law bill. So rule bill in short, and I will get back to that very shortly. So I will focus the remainder of my remarks on some of the key findings of the report relating to the recent trends of UK regulatory developments, the 3 scenarios that we built about future divergence, and some options for equivalence. So the rationale behind the review of financial services regulation in the UK is basically driven by a willingness to favor flexibility, a principle-based approach, but also this is very much in line with the common law tradition, if we can make a general observation. If we look at the review at the different stages of some of the consultation and amendments that have already been discussed among politicians and or regulators, they want to stress competitiveness, growth, and innovation. And these objectives have been even further reinforced with lately a policy paper that has been published a couple of weeks ago, which is entitled Smarter Regulation to Grow the Economy. So initially, a few weeks ago, I was emphasizing some data because those of you are very familiar, so the UK government has a dashboard following very closely the files in terms of which retained EU law has been already revoked, amended, or repealed, and so on and so forth. This is moving a lot, and actually here we can say that by the end of the year, so they want to get rid of the sunset clause, but they still announce some hundreds, so 600 to be exact, retained EU law that would be revoked or reformed by the end of this year instead of the sunset clause. And if we look at the overall numbers, by the end of this year, this would lead to roughly 42% of the retained EU law covered, whereas we stand nowadays, so if you look at this interactive dashboard online, we are at 22%. So you see the objective is much lower. Of course, the initial objective they had was 100%. Anyway, so this, and here I'm talking only about retained EU law in general. If we go deeper into the financial services area, the numbers are even lower, of course, and this shows, at present stage, a low divergence of UK financial services regulation from the EU in quantitative terms. But if we take a step back, the UK approach to regulation will lead to transfer most rules from the statutory level to the regulator's rule book. And this is a major change, a major departure from what we have in the EU. The approach would aim to rely on less stringent rules and their transfer into administrative, technical guidance and in these rule books. And here, this approach, according to the UK, is instrumental to enhance the international competitiveness, the growth of the financial services sector, but at the same time, it's at the expense of accountability and also parliamentary scrutiny, because you're moving some powers from one place to the other, I mean, in the hands of the regulators. And one major change to keep in mind is most likely once the Financial Services and Markets Bill will be approved, the mandate of the Prudential Regulation Authority and the Financial Conduct Authority will include a new secondary mandate, new secondary objective within the mandate that is for growth and international competitiveness. And this is also part of this strategy that I was mentioning earlier to build a smarter financial services framework, and that was also reiterated in the Edinburgh reforms in December last year. Last but not least, as part of this change and this overall of the regulator's mandate, you have this regulatory principle to center their work also on the UK net zero emissions target as provided in the UK Climate Change Act, and this is also a major change. And if we move from financial services regulation stricto sensu to UK trade deals, because in the UK trade deal there are some financial services chapters, and since Brexit, of course, some trade deals have been adopted, and here I'm referring only to the trade deals that are new trade deals, not the continuity agreements that were adopted just for the transition, so to say. And without going into much details, the evolutions showed an effort to strengthen the UK position as a globally competitive financial hub, and they emphasized very much digital and sustainable finance. On the one hand, for digital finance, you have digital trade agreement or digital economy agreement. This happened with Singapore and Ukraine. And for sustainable finance, basically you can observe in these financial services chapters some provisions that are stressing some commitments for sustainable finance. Then we may have a discussion later on in your Q&A as to the implementation of these commitments and if it's really sort of a major change. And just one main observation, the fact that we can observe the UK following a sort of shift and a strategy toward the Indo-Pacific region, and that was very much the fact with the conclusion of the negotiation to join the Comprehensive and Progressive Trans-Pacific Partnership at the end of March. So, moving on to the scenarios for future divergence. Of course, the degree of divergence will have important repercussions for the UK-based financial sector providers to the EU single market and vice versa, of course. And in the report, we go with my co-author, we go through many parts of the financial sector regulation, so subsector regulation, but here just to give you the 3 possible scenarios of divergence we outlined. The first one would be low divergence, and there would be adjustment to some UK regulation as well as other initiatives that aim at increasing competitiveness of the UK as a financial center, but also the economy, but areas with international standards, and here we can think about bank capital regulation, would remain at a low level of divergence. So this is the first scenario. Under the second scenario, of course, there would be more divergence because this is called, we called it medium divergence, and there would be fewer attempts to converge on some new rules or standards, and this could be observable potentially from our viewpoint in 2 types of area. First, wherever these international standards are less preeminent or sort of more loosely discussed. And secondly, wherever the UK has not inherited any EU regulations. And here we can think about green finance or digital finance, because many files were just at discussion stage or not yet approved, adopted, and implemented in the UK. And last but not least, the third scenario, under high divergence, there would be an aggressive legislative and regulatory drive in the UK to diverge significantly from the EU. Here we can think, of course, of replacing and revoking EU rules with new regulation on rule books, and to adopt also such divergence approach wherever rules were not inherited from EU law. And this could happen in particular areas, for instance, where the UK already highlighted some growth opportunities, and here this resonates with the objective for growth and international competitiveness, like as for crypto. So for crypto assets, stable coins, they have already, they are very much active to develop some sandboxes and so on and so forth. So on the semantics, I think I want just to disclose one point. I'm very much aware that if you have one country living a common project and being a third country, of course, there would be some divergence. So I'm not really contesting this term. And then as to the likeliness of the scenarios, it's difficult to know how they will play out, because it's very much moving still. I mean, we've seen that in the last 2 weeks, already sort of having a different approach towards retained EU law. But we can stress that with the MOU, and I'm pretty sure we'll get back to this point in the next interventions, and the upcoming joint regulatory forum, this could very much favor a state of play where we are in between the low divergence scenario and the medium divergence scenario. And the recent political declarations, from what I've seen on both sides of the channels, would be, I think, in favor of a rather minimal divergence option in the financial services sector. So definitely no Big Bang 2.0. I know that we've seen that a lot in news for this sector lately, but I don't think it would be the case. And the very last point, if I may, would be for equivalence. So I know that Massimo will get back to this point, so don't worry, I'm not going to get into too many details. I just want to limit myself to one general remark on the regime that is applicable towards the UK, and then the options that we discussed also in the report. First, the EU's approach to equivalence is restrictive towards the UK financial services sector. At the moment, we only have one equivalence with UK CCPs, and it may become even more stringent. And here we may get back to this discussion, because lately, in December 2022, the European Commission put forward a number of legislative proposals to favor capital markets union, and as part of this, we could interpret this as being more restrictive and more stringent towards equivalence. So we may discuss this development of the internal EU clearing capacity. This is also part of strategic autonomy for capital markets and so on and so forth. And also the fact that we can very much observe that in the meantime, there have been many equivalents granted towards CCPs in other third countries. So there is also a strategy to diversify and to have other possibilities elsewhere, which may be in favor of diversifying risk and less financial stability risk, but then here we can get back to this point. So very last point would be the scenarios for granting equivalence. So We elaborated 4 scenarios for equivalence granted to the UK in the future. The first one would be no equivalence at all. So here, the current CCP's equivalence lapses in June 2025, and there wouldn't be any renewal or new equivalence granted. There, that would mean that probably the regulatory forum is active on other files that are sort of avoiding this path, but, well, we can discuss this. Second scenario, no additional equivalence or unique temporary equivalence. So here we would focus really very much on the UK CCP's equivalence that exists, and this one might be renewed for some technical reasons or some practical reasons. Third scenario, a bundle of equivalence or multiple partial equivalence, and last but not least, the one that is very unlikely to our mind, a furnished and unlimited equivalence regime. So one general observation is to say that the equivalence regimes are inherently dynamic. The cross-border regulatory alignment that exists between 2 blocks, so here between the EU and the UK, requires continuous close cooperation, and here the current developments are very positive. But you need mutual understanding, mutual updates, continuous dialogue, so this is where I will leave it to my co-panelists to elaborate further on the future status of equivalence. Thank you.
Thank you very much, Christy, for laying out the key issue, and also, I think, for summarizing very effectively the core content of the report, which I really recommend to you as worth reading in its full extent. I'm now very pleased to move on and hand the floor to Massimo Zaffiro, thanking him for keeping on hold the Memorandum of Understanding for 2.5 years, 3 years, until we could organize this event. That was very much appreciated, so we could be very timely. Jokes aside, the floor is yours.
Thank you very much. Thank you all for organizing this event in the first place, and also thanks Christy for the presentation she just gave. I would also like to comment the paper that she has written together with Professor Beck, which it's a quite remarkable piece of work in my view, and addresses a number of very topical issues. So we also find it a very useful document from a purely operational point of view, if I can put it that way. First of all, I should start my introduction by excusing my director, Paulina Dajmek-Hack, who was supposed to be with us today. She unfortunately couldn't make it because she's traveling to London with the Commissioner. You may have read that on the press as well. Commissioner McGuinness is in London today and tomorrow. She will have a number of high-level meetings. This, including with Governor Bailey and with Chancellor Hunt. Now, of course, this was all planned before the adoption of the MOU. I believe also this very event was also scheduled before the adoption of the MOU. There is some continuity and good sequencing in timing, of course. Indeed, it has been kept on hold for over 2 years, as you correctly said, and adopted just last week by the Commission. This kind of had an impact on my own presentation as well. I had to restructure more or less what I was planning to say to you all. Today, in any event, I think it's very good that this document is now in the public domain, and this will allow us to have a more frank and fruitful discussion, I think, on the overall state of play. Coming back to the content of my intervention. Well, I think as you all know, I mean, in terms of regulatory cooperation between the EU and the UK, there hasn't been so much going on since December 2020. Brexit was indeed a breaking point in terms of financial services. This does not mean that cross-border provision of services has ended on the day of Brexit and after the end of the transitional period. UK firms have continued operating into the single market under a different regime. They have, of course, lost all passporting rights, but they have to be reauthorized by the ECB insofar as the SSM is competent, for instance, or by national competent authorities. And likewise, EU entities have continued providing their services into the UK market under a different, I mean, in most cases, temporary regime. But anyways, now leaving aside all the technical complexities, I mean, let's say a new equilibrium, if I can put it that way, has been found. Now, the fact that there was no structured regulatory cooperation in place until now doesn't mean that, of course, we have stopped talking altogether. Of course, the broader political developments, you mentioned the protocol at the beginning of the session, that had an impact on the overall relations, and of course, financial services are not detached from the broader political reality. So that was an important part of the picture. But I think also the latest developments the broader geopolitical developments in the last 2 years, for instance, with a war coming our way, and unexpected reasons to cooperate on issues such as sanctions, for instance, which at the time when we negotiated this document at technical level were more or less unforeseeable. But I mean, it brought both sides to the same table under different capacities, in different constellations, of course. And on top of that, there has been a number of areas where we have continued cooperation at multilateral level, of course, because, I mean, I think we are as large and responsible jurisdictions, both an important burden to carry in terms of standard setting at international level. And now, regardless of whether we have a bilateral MOU in place or not, I mean, these various work streams have continued in the last 2 years. But I think, I mean, what is more important, what is important perhaps to stress out is that, there was a risk of a cliff edge effect at the time of Brexit. I think thanks to, good preparatory work on both sides, this risk was to a large extent avoided. There was, for instance, there were a few equivalence decisions that we had to take at the time in order to avoid some potential heavy consequences in that respect. But overall, I think the overall outcome was in the immediate aftermath of Brexit was pretty satisfactory on both sides, both from a regulatory and from a supervisory level. Coming now to most recent developments, this document, which the MOU, which you are, I think, by now more or less all familiar with, was negotiated by us together with our colleagues in the UK Treasury between January and March 2021. We were at the time following up on a commitment taken in a joint declaration, which had been adopted alongside the TCA, which said that both sides had agreed to establish a regulatory cooperation in the area of financial services, and in order to formalize this cooperation should have agreed on a memorandum of understanding. We have now, as early as last week at Commission level, adopted a draft document. I would like to stress out that the document is not signed yet with the UK. In terms of process, this is being adopted within the EU as a union non-binding instrument. This means, according to EU law, that in order to be able to sign it, the Commission needs to receive political endorsement by Council first. So the adoption of the draft MOU by the Commission last week was a necessary step in order for us to then transmit the document to Council. I think the discussion with Council will start very, very soon. Timing and modalities are yet to be arranged, but in any event, we expect this political endorsement to come our way soon in the next few weeks. Once we receive it, then we will be ready to sign the MOU together with the UK. Once again, I cannot give you a precise date for that, but at this point in time, we expect this to happen not too far away in the future. So that is so much for the process. In terms of content, which is probably the most important thing today, in the end, I think the content of the MOU itself, the draft MOU, was out in the public domain for a very long time now, regardless of whether it had been adopted by the Commission or not. So there are not big surprises in that respect. I think it's very important to stress out what the MOU, what it is actually in the document, or what it is not. So what it means in terms of cooperation, and what it should not be interpreted as in other domains. So what it is about in the MOU, you will have seen it, is a document which established a structured cooperation which has to be understood as a voluntary commitment by both sides to sit together on a regular basis. The document would require that we organize meetings on a semi-annual basis. So at least twice a year, we would sit together with our colleagues in the UK and compare notes on a number of regulatory developments. There's a macro element to that, so we would be discussing also, I believe, respective concerns in terms of macroeconomic developments, as well as key financial stability issues. We would also expect to discuss with our counterparts more concrete, more detailed regulatory developments in a number of areas which are not exclusively defined, are not defined in the document, in the MOU, in an exclusive list, but could be raised as either parties consider appropriate. And then, last but not least, the document also contains a reference to equivalence. I think this is something which should be clarified insofar as it's clear for both parties that the MOU would not have any impact on either side decision-making powers in that respect. So there is a commitment to exchange views and inform each other about potential decisions to be taken, about decisions to be potentially withdrawn, if should we ever get to that situation. But I would like to stress out once again that equivalence does remain a unilateral tool, a prerogative of the Commission, and therefore the impact that signing the MOU will have in that respect should not be overestimated, I would say. As regards next steps, should I continue? Yeah.
No, continue.
As regards next steps, as I said, we'll still have to discuss with our colleagues in the UK about timing and modalities of the signature of the MOU. Once the MOU is signed, we will be ready to start with the regulatory cooperation. In very practical terms, the MOU will establish a joint EU-UK regulatory forum, something which is not very different than what we have in place with other big jurisdictions, such as the US already. There would be, I think, a number of mechanisms to be put in place in order for us to be able to inform our stakeholders on both sides before and after forum meetings. But again, I think we would draw largely on the experience that we have, the fruitful experience that we have gathered already so far in our other cooperation structures that we have in place with other like jurisdictions. So it's probably too early to give a date as regards when the first forum will take place, but I think we would expect this to be at some point after the summer break, surely not before. I will leave it at that for now, and then of course I'll be happy to take any questions, and back to you. Thanks.
Thank you very much, Massimo, for that, and sorry for interrupting you earlier on. There was a problem apparently with the audio of the streaming, but that was solved. Thanks a lot for giving us also the inside perspective on the negotiation of the MOU, which was really extremely helpful. And it's now my pleasure to hand over the floor to Andreas Heinzmann, a partner at GSK Stockmann, who I think I'm entitled to say has recently opened an office in London. So from Luxembourg also cooperates across the channel with his office in the United Kingdom. Andreas, we're delighted to have you here. The floor is yours.
Yeah, thank you very much. Hello, everyone, and thanks for the very interesting contribution so far. I think my role today is to shed also some light on that topic from a practical perspective. And I think, first of all, I think this memorandum of understanding is a very good thing. Obviously, it does not grant market access for any UK bank or investment firm, but it already shows that the EU, the stakeholders here in Brussels and throughout the EU, and their homologues in London, they are again talking. I think that's a very important sign. Because we, I wouldn't say certain processes have been derailed after the Brexit, but it was obviously, let's say, very, very complicated. I mean, we heard already before the term capital markets union. That term comes from a time where obviously the Brexit was not really in sight. It was maybe looming at the horizon. But the capital market union aimed at SMEs have a different access to funding. And obviously, I think that is now a bit jeopardized because many funding sources are actually located in London. And I think it's important to say that now we have a specific situation that we have maybe a certain demand in the EU, but the supply is given in the city of London. That is something we need to repair in a certain sense. Well, I think if we talk about the single market, which is obviously one of the largest achievements of the EU. And we are thinking about this revolutionary idea that if one regulatory authority grants the license, then that entity can also operate in another EU country. And then you think about the Brexit, where, so to say, the largest financial center in Europe has no longer access to that market. That is obviously problematic. I mean, we have seen various passporting issues in the past, be it banks, be it insurance companies, be it in the fund industry, or payment services, which is also very important, and that passporting mechanism facilitated obviously lots of things. I think what we have also seen in the past, and that is now, I think, also not longer the case because Brexit has crystallized that as well. The so-called reverse solicitation, and maybe let me just say a few words on that, which at least in the corporate lending or banking space was always an important tool. I mean, first of all, what does reverse solicitation means? It means if a client applies for services from a asset manager or from an investment firm, then in that case, that firm does not necessarily need to be regulated in the country in which the services are supplied. Certain regulators, for example, the BaFin in Germany, they had a relatively vast understanding what reverse solicitation means. So they were rather, I wouldn't say in favor of that, but they did not regulate it in a very harsh way. Other regulators, like in France, they saw that completely differently. And now, let's say with MiFID and MiFIR rules, in particular in the MiFIR, there is an article about reverse solicitation which already reduced a bit the application. And then came Brexit, and I think then ESMA made a statement saying, look, and now we are coming back to substance, if you are supplying services which are regulated, for example, by MiFID or MiFIR, then you have to have a local regulation, which then led to the idea that many organizations which were regulated in the UK, but not necessarily in other European countries, that they were forced to move from London to the continent. And I think For large institutions, that was already the case. If you think about the banking or insurance sector, they had already regulated entities in the large markets like Italy, Spain, France, or Germany. But I think, and then I'm coming back to the SME and capital markets issues. Very often for corporates, for SMEs being in need of financing and maybe also a certain distress situation, London was always an interesting market, and they could rely to a certain extent on this reverse solicitation mechanism, which allowed then a London asset manager, for example, to provide a loan to a company without being regulated in the country where the borrower was located. That is now, I would say, over, or at least it becomes much more difficult. And the regulatory penalties, obviously, they are quite harsh. So I think also after Brexit, this reverse solicitation scheme or mechanism, which always provided some flexibility for a certain situation, that is also no longer available, and therefore again the possibility that now on a political level both the UK but also the EU, they are talking again, and they are trying to regulate this issue that the financial services are not really covered by the free trade agreement between the EU and the United Kingdom. That here maybe we come to a better situation and a better solution. So, in my opinion, and it was already said before, when the Brexit came, the regulators, the politicians, they reacted quickly, but also the markets reacted quickly. So we did not have really a meltdown in certain situations, and when there for certain sectors where immediate regulation or decision taking was necessary, in particular in the clearing space, there we have, and that was also said before, this equivalence decision. I think it is limited until 2025, but I think here we have already come to a solution. And I think now we just need to see how things are developing. Personally, I do not see any equivalence decision very soon. And on the other hand, the market has already adapted. Those entities who needed a regulation in the EU, they have it. And I see rather the problem, and then maybe also the opportunity for this memorandum of understanding for the smaller or medium-sized companies on so to say both levels. On the one hand, on those who are providing asset management, payment or loan services, but also then on the demand side, namely SMEs. And here I think here lies rather, so to say, the opportunity also of that agreement, besides the political level, namely that stakeholders, they are talking to each other. And I think that's a very good development. On the other hand, it shows, at least at the moment, there is no way back from the Brexit. Now we try to establish a common understanding how rules are applied. And on the other hand, the UK, if they would like to have a good understanding with the EU, they need to follow certain decisions on the regulatory level, which are made here in Brussels. So at the end, I think it becomes once again apparent that the Brexit was really a politically driven decision and not something where some economists sat together and said, well, let's do that because it will bring us some advantages. I mean, we see that not only in financial services, but all over the place with regard to the statistics we have from the UK. Therefore, again, this memorandum of understanding, I think, is very good, also for the financial services industry as a whole. And when it came out a couple of days ago, the Luxembourgish government, they were very happy. They did a press release also because Luxembourg and the City of London, they were working closely together in the past. So I think, that's maybe from my side what I can say regarding the practical impact of the Memorandum of Understanding. And I think giving back the floor to you, Federico, for questions probably.
Thank you very much, Andreas, for bringing in an extremely helpful and insightful perspective as a practitioner. We are coming for full circle to the other side of the table, back again to Antonio Garcia del Riego, who has already opened up, but now I think is in an ideal position to react also to what the other panelists have said and add, of course, his own comments and thoughts on the topic. So, Antonio, the floor is yours.
Thank you, Federico. Well, let me start my comments where Andreas closed down, and that he was reflecting on the fact that the transition, the Brexit, has been carried out in an orderly manner in the financial sector. When you compare this transition with other parts of the economy, it has been done in a very exemplary way. And in spite of the fact that some significant movement of trading in shares and derivatives has taken place. And this is due to, in my view, to two main elements. Number one, the financial firms, financial institutions, worked hard and were able to preempt most of the operational challenges beforehand. And secondly, because of the technical cooperation between authorities in charge of financial stability, namely Bank of England and the ECB. This cooperation, the technical cooperation, has run very smoothly, which opens the door for me to comment on the role of the ECB. The ECB, it is not part of the memorandum, it is not part of the, but it is obviously a very, very key player on how the financial sector is being supervised, obviously, in Europe. In that sense, I would like to pinpoint one important principle from the ECB, which is that no empty shell or no PO box entities would be allowed to play within the European market. The ECB has always emphasized the need to have the strategic and risk management capabilities based in Europe, based within the unit created in the at European level. And also they have emphasized that the boards of the EU entity should be of sufficient number and quality, should have sufficient number and quality of independent directors, and to avoid what they called the dual hatting. In other terms, having members of the board in the European institution sitting at the same time in the parent company, in this case in the UK or elsewhere. And it makes all the sense, in my view, because dependence on the city or in any other center entails a financial stability risk in Europe. In a crisis, UK authorities would respond in a way to protect UK interests, relegating EUs to a second place. And we have seen that in the past. That is not a theoretical game. Before the crisis, at the beginning, in the middle of the crisis, at the beginning of the years 2010, we have seen how the UK authorities privileged the stability of the pound vis-à-vis the stability of the euro. And some institutions in the European market suffered because of that. So it makes, in my view, all the sense to preserve the autonomy and the capability to react to defend and to fend off any financial crisis in the European territory. So, what else I want to say? Well, the coupling or the way in which the regulation will evolve, my view is that it is difficult to predict, but most probably it will not be a uniform. It will not be uniform across all parts of the financial system. Regulatory competition may become a race to the bottom or a race to the top, depending on market segments and the circumstances of the moment. For instance, now we see that if we compare the European regulation with, for instance, the regulation in the States, we see that Europe is more demanding on curbing bankers' compensation, but easier when it comes to enforcing security laws, for instance. We have seen at the same time that the UK is toying with the idea of relaxing banking remuneration in the banking sector in the UK as a way to attract more talent to the city of London. At the end of the day, as I was saying before, this is an asymmetric game. London perhaps, London is playing a key role at the global level. Sometimes they will need to compete with other global places. So it makes all the sense for them to consider the possibility of competing in that segment of the regulation with other local players, or with other global players, I meant. So we know also that the UK aims at reforming different aspects of the wholesale market, wholesale markets regime, and is planning to become a global center for fintech and crypto assets, and Bank of England is encouraging the development of stable coins. On equivalence, many things have been said. What is important to remember is that even after the signing of the Memorandum of Understanding, proportionality and risk-based assessment are still there, and unilateralism and discretion will be there. On the positive side, equivalence will be positive for efficiency, but negative for stability. Data exchange and supervisory cooperation, and cooperation in crisis, and very negative for Europe, considering its strategic autonomy objective. So we will see how the situation evolves, but my view is that equivalence will be always a very, let's say, unpredictable tool, which it obviously will not be of much help for the markets. Well, on the MO, I share the view that is very positive, obviously. It paves the way for political endorsement by EU members, as it has been said before, and creates a format for a regulatory dialogue. It has been mentioned also that the EU will remain master of its own house when it comes to equivalent decisions, and it will be a good tool to force the European financial centres to reduce reliance on London as a financial centre when it comes to clearing and trading. It is also important to encourage a direct upstream discussion between the two sides as an antidote to mutual suspicion, which has been, in some degree, the situation up until now. It doesn't secure, though, a strong guarantee of upstream input ahead of moves by the EC, by the European Commission, to adopt, revoke, or suspend equivalence decisions, and will not restrict the ability to implement regulatory, supervisory, or other legal measures that are considered appropriate. And with that, I will finish here my reactions to the comments already made, and open to have further discussion on the topics. Thank you.
Thank you so much, Antonio, for your input on this. Was glad to see many points that are recurring, of course, in all the presentations. So instead of abusing my role as chair, I will immediately open up to the floor for question. I will ask people to raise their hand. I will ask people to click on the microphone so that you can be heard on web stream. And I will please ask people to quickly introduce themselves so the panelists know who you are. So who would like to break the ice? There's definitely a lot of meat on the table. Please.
So look, Hi, Marcus Meyer from the Brussels office of the City of London Corporation here. So I was great to read your report, and I was very interested in reading your report, and very happy to welcome the Commissioner today in our premises in London as well. So that's great as well, and I think it's a good sign for, cooperation working better again. I think there are a lot of things that you mentioned in your round today that we can underline. So what just was said in the last moment, this importance of avoiding mutual suspicion, of building mutual trust. I think these are two key issues that we will need in the future. And that's also a reason why we still have an office here. So please come to us if you have questions. I have one question. So you mentioned equivalence quite a lot. Where would you see in a medium future potential for equivalence decisions? So do you have any specific areas where it might make sense or is possible relatively soon? Thank you.
Thank you very much. And if I can now abuse my role, I actually had a sort of a follow-up question to the panel. So throw it out there to be joined with the one that was just posed. Some of you will know I do run a book series called The Law and Politics of Brexit, published by Oxford University Press, now 4 volumes. And so my question to the panelists is, to what extent is this law, or is it just all politics? I mean, even the fact that the MOU was kept there for 2.5 years is just politics, isn't it? And we can expect politics to still dominate any financial service-related discussion with the UK moving forward. Ultimately, this can be an asset for the European Union in talks with London. So are we dealing with a groundbreaking change here, or is it just a positive step due to the political realignment between Brussels and London, but how long can we expect that to continue? And I hope I'm not too provocative, but I'd love to hear the thoughts of the various participants on this. And perhaps we can start with the same order of presentation, or Massimo, you want to go first?
I think
sure, Massimo, go first.
Thanks, Federico. Yeah, at risk of disappointing someone in the room, I don't know to what extent I could speculate at this point in time on equivalence. Perhaps I go to the point on the politics first and then move to equivalence. So whether it's all politics or not, no, I would not say it's all politics, but certainly it is also about politics. I mean, Brexit was, someone mentioned it, during the various, it has been mentioned during the various interventions. I think it was Andreas. Brexit was certainly not only about economics. And I guess particularly in the financial sector, there are clear indications that, I mean, this hasn't been a win-win for sure. Whether it's a lose-lose, I don't know. Certainly, I mean, I think we were both better off before Brexit. We are still adjusting, but politics will continue to play an important role in that respect. Now, I think this is true on both sides. It's obviously, I mean, Brexit has been a legitimate, fully legitimate political choice by the UK government. There's been a number of announcements in the area of financial services ever since. The package of reforms or other announcements, which is commonly referred to as the Edinburgh proposals, is simply the last one. There will surely be others. But what is true is that a number of consultations are still ongoing. We are obviously monitoring all the various developments, both as regards sector-specific legislation, as well as the broader developments as regards the future regulatory framework with great interest. But it's, of course, very much up to the UK government and Parliament at the end of the day to decide where they intend to, and regulators, obviously, to decide where they intend to land on the various areas. So I think it's too early for us to comment on that for sure. But what I can say already now, coming back to the point on equivalence, is that the level of divergence, if I can put it that way, will certainly have an impact on which equivalences are granted and in which areas. Now, when we're talking about equivalence, it's also, I think it's also always taken taking for granted that there is also a strong demand in the UK to receive equivalence across the board. Now, of course, I think there is some interest from the financial services sector. But once again, equivalence does not mean financial service, does not mean market access per se. I mean, equivalence means many different things. There's a number of equivalence frameworks which are there primarily to benefit EU players. If you think about equivalence in the area of banking, for instance, I mean, this has nothing to do with cross-border provision of financial services. This is about reducing the cost of capital for EU banks operating in the UK. So one may very well argue that could be clearly in the EU interest to give it or not. But once again, I mean, it has to be taken as a bundle. I think Antonio mentioned a number of times the potential risk implications in relation to that. I mean, clearing is a very clear example. Also, Christy mentioned equivalence in the area of clearing given to other jurisdiction. But just to mention one recent example, which has absolutely nothing to do with the core topic and the discussion today, the recognition of the Indian CCPs, for instance, which had to be recently withdrawn by ESMA, further to the failure of both sides, say, to agree on a memorandum of understanding, which is one of the key requirements for third country CCPs to be recognized. I mean, these kind of things have an impact at the end of the day, a serious impact on market players, and I think it's in everyone's interest that we don't put ourselves in a situation where we should rush into giving equivalence decisions in order to have to then have to reconsider and potentially withdraw them. Now, I'm speaking, of course, under very, very general and theoretical terms, but it is just to say that we'll certainly consider whether to resume equivalence assessments once the cooperation framework is in place, and once we get to the stage, we will, of course, see whether any sequencing in those assessments should be implemented. Thanks.
Thank you, Massimo. Antonio, you wanted to come in as well.
Yes, very briefly. I agree with Massimo when he said that equivalence is not all politics, but politics are involved. I think that it summarizes very clearly. And I think, but I have to say also that at the very beginning of the Brexit process, the politics played a much stronger role that we are seeing place today. So maybe we can derive from this fact that there is a sort of tendency going on towards more technical analysis of equivalent decisions based on outcomes than the political factor in it. And also, yeah, I mean, it is my view that at the end of the day, the coupling and divergence is going to be there. I mean, at the end of the day, it is part of the reason of why Brexit came along, which it was basically to gain sovereignty and to have everything under the control of the UK authorities. So, and it is also a fact that the UK will be treated as a third. It is already a third country. It is already a third jurisdiction. So, my view is that politics will become less of an important factor, and the technical issues will be more important. And yeah, and that's it. That's it for me.
Thanks, Antonio. You mentioned decoupling. Of course, the buzzword in Brussels, I understand, is de-risking, which I think is also connected to equivalence. Christy, probably you wanted to speak about that too.
Yes, I mean, very quickly, maybe just to focus on, it's not only about politics. So getting back to the law and to say, basically on the EU side, you do have legal provisions at secondary law level, so in directives, regulation, and so on and so forth, providing for some equivalence regimes. Sometimes they are activated, sometimes they are not. And then we have the ESAs being involved at technical level, and then a decision by the Commission. So here I see it as a highly legalistic process, no? And also because you're looking at all the supervisory regulatory frameworks on both sides, and it's a sort of, it's very dynamic, as I said in the introductory remarks. It's relying on reciprocity, but here comes the political assessments, of course. But then if the mutual trust is there and there is a working cooperation at broader level, then I don't see this, if we zoom in, I don't see this as only political, but mostly legal, because then we get back to the book. No, we get back to what are the rules on both sides, and then if we look at reciprocity, I mean, there is an intent on both sides that it's working, because ultimately it's benefit the financial services sector as well. So sort of, you know, so being pragmatic, I think we can rely on these rules and in this framework.
Thank you, Christy. Andreas, you wanted to jump in too from a practical perspective.
Yeah, indeed. Thank you. Yeah, the reason why we opened, for example, our office in London last year was that we do not foresee that there will be a fundamental change very soon. I think you can still sense it now from the discussions here. The Brexit had a very large impact. And therefore, it's very good that we have now this memorandum of understanding. But I think we have to live with that now. Who knows? Maybe in the UK there will be a different political point of view in the future. Who knows? In Europe, it would need to be the same. So it's a very complex issue to align that, and I think we need to be pragmatic in that regard. I think that we have now this memorandum of understanding in place is already a very good step, that we are breaking it down a bit more to the technical level and moving away from the political level. But given the reasons why Brexit is there now, I mean, they are still very much, I think, alive in the political debate. If we talk to our contacts in London, they say, well, maybe nowadays if we would do a referendum, then maybe 52% would be against Brexit and 58% in favor of Brexit. So it has not fundamentally changed. And therefore I think it's important that we continue to talk to each other. But I think for everything concerning the single market, probably the UK will remain a third country for the foreseeable time. And I think we just need to adapt to that.
At least until the next British election, for sure, we can be pretty confident about that. Thanks a lot, Andreas. I'm happy to open up the floor and perhaps collect a couple more questions. First row, I see.
Yes, thank you. Christian Schindler from the Austrian Central Bank. My question is more related to, thanks for the discussion and for also this report. And in the report, you have 3 scenarios. And you mentioned that you think that the low divergence scenario is the most likely one. I just want to go back to the panel, if this is the view of everyone, because I wasn't sure listening to some of you, or if you see more other scenarios as more likely. And if we talk about low divergence, do you think the MOU with the forum is the best, is a good platform to achieve this? And maybe we don't even need equivalence, because if we have a regular exchange, it can be, well, avoided or become not as important. Yes. Thank you.
Thank you very much for this question. I think, Christy, you should probably approach it first, because you wrote the report, and then we'll ask.
But I think I outlined very clearly between low and medium divergence, I would say. And then, I mean, that's what we said 3 weeks ago with my co-author. Now I would lean even more towards minimum divergence because of the favorable context. Then, I mean, I would be happy to hear my co-panelists to see if it's realistic to have this view. And also, I mean, as regards the second part of your question, sort of the regulatory forum and you know, these regular discussions, I think it probably depends what we're looking at, because probably, I mean, some of these provisions that are there and that could be activated towards an equivalence regime might be beneficial, but then how to get there, I mean, it's impossible probably to predict, but building up scenarios, we could say 2, 3, 4 years, 5 years, but then we need to look back into what is the government, what are the elections, what are the priorities. If you have like a geopolitical event coming, I mean, sort of, you know, then it's probably shifting all the files. So getting back to the initial answer, probably more low divergence and then a regulatory forum that is up and running. And sort of also we need to think that this semi-annual basis, it's the formal meeting of the Joint Regulatory Forum. It means also that there are a couple of meetings before. So, you know, and at the same time, regulators have been speaking and they will continue working together. So sort of, I think this is all contributing to good exchange of information. Massimo, maybe.
Massimo, please.
Thanks, Christian. It's a difficult question to answer, I think, because, I mean, we are a bit in an unprecedented scenario here, both in terms of cooperation and in terms of equivalence in particular. I think the two things are linked. I mean, equivalence is the way it was conceived. In the end, it is a supervisory convergence, regulatory and supervisory convergence tool, which helps market integration, but normally comes at the end of a convergence process. Right, so we discuss with third countries, whoever wants to be considered, or for any reasons, because we think it's worth assessing a specific jurisdiction, and then, you know, legislation on the regulations could more or less be aligned, and then we consider that, you know, it's the right time to grant an equivalence decision. Here we are in a completely different scenario for the first time since equivalence policy is being implemented, which is we are starting from complete convergence. So all financial services acquis had been onshored. And despite the several announcements, in fact, I mean, most of the legislation is still being applied the same way as it was when the UK was a member of the EU. But however, we cannot disregard the announcements and once again, the very legitimate political agenda that the UK government may have in terms of, we call it divergence, but I mean, again, it's about setting political priorities at the end of the day. So if you look at the facts as of today, I mean, if, again, coming back to the initial point, if this was purely a technical discussion, then equivalence could have been granted in all areas one day after Brexit. But obviously, I mean, this is not a realistic scenario. Now we'll have to see where the various ongoing consultations and reviews end, but where the cooperation would be a substitute for equivalence, or where the cooperation would have the regulatory cooperation framework rather would have a decisive impact in influencing the choices of the UK legislators. Well, I don't think that's the purpose, isn't it? In the end, I mean, these are decisions which are taken elsewhere. I think it's very important that we have a structured platform so that we can keep each other informed and avoid any first and foremost risks in terms of financial stability. I mean, look, for instance, at the recent banking turmoil, which has hit us both differently, but in the past weeks. I mean, these are things which are part of everyday life, right? So they have happened in the past, they will possibly happen in the future, with or without a regulatory cooperation in place. But having a well-functioning regulatory cooperation framework will allow us to preempt and prevent, to some extent, at least surprises on either sides. It's not the only way of exchanging information. I would like to stress out this once again. I mean, we have Basel, we have the FSB, we have the G20. There's a number of areas where we talk together with other jurisdictions. But this would be indeed a way of exchanging information on a structured and a regular level. But I would not overemphasize the impact that this could and rather should have on the political competitiveness and, at the end of the day, regulatory agenda that will be implemented in the UK in the next month. Thanks.
Thanks, Massimo. Maybe, Andreas, do you want to come in on this? I mean, a question I had for you as someone who works on this from a practitioner perspective. Where do you see pressure from the industry to diverge? Is it happening on the ground, or rather industry is pushing for convergence?
Yeah,
which is basically the same question asked in a different way. Right?
Yeah. I think to come back to the to the question, it's at the end it's really a legal question, because this memorandum of understanding does not set any legal standards or obligation. It's more, as the name is saying, kind of declaration that I rather see it as a political statement, but it will have also some practical consequences. But if you look at the frequency of meetings, we heard exchange of information, financial stability. That does not mean market access, and probably, at least that's my understanding from the comments before, it is also not intended to be understood like that. So, and coming back to your question, Federico, with regard to the pressure from the industry, I think that we heard that before, the financial services industry weathered relatively well the whole Brexit scenario. There are situations which I alluded to before where obviously parties are maybe suffering from the current situation, and we would have a better situation without Brexit. But I think the current scenario we have is working well, also because the regulators, the central banks, they acted swiftly. They had also good input from the industry. One should also not forget that the financial services industry by nature is cross-border, and risks were detected relatively swiftly. So now I think we need to live now with that situation. I think the majority in the financial services industry did not want the Brexit, also in London, were firmly against it, also understandably. Would not have been reasonable to be in favor of Brexit. But I think now the cards are on the table, and it's working relatively well. At least I cannot see that there is, let's say, that there are severe issues. There are probably two concerns. The concern in London is probably to say, well, gradually we will lose competitiveness, maybe. because we need to transfer certain parts of our industry to the EU for regulatory purposes. For example, clearing is one point which is still not resolved. And then on the other hand, on the EU side, we need to make sure that we remain in contact with the City of London. Probably it will lead to further cooperation between, I would call them regional financial centers within the EU, be it Frankfurt and Paris, Luxembourg, Milan, Amsterdam, you name it. But London is much larger, and also the know-how is there. So now we need to find a way of working it out together. And I think people are pragmatic, but I don't see that the Memorandum of Understanding is now a game changer in terms of, let's say, market access that would somehow reverse the decisions or the consequences of the Brexit.
Thank you so much, Andreas. And I hand over to Antonio.
Yes, thank you, Federico. Very briefly. In this discussion about equivalence and cooperation and the future outlook, I think that it's important to keep in mind the clearly defined objective of the Commission to gain a strategic autonomy. And in fact, when you read the declaration, I don't remember when it was formally issued, they made a concrete point about the importance for the financial sector in Europe to gain autonomy and to depend, not to depend too much, not to over-rely too much on foreign financial institutions. And this is very, I think that is a factor to consider in this discussion, mainly when you realize that today in the investment banking side in Europe, in the investment banking segment in Europe, 60% of the market is controlled by 5 American banks. And 15 years ago, the market share of these 5 banks was 40%. So the trend is already clear as well. No autonomy today, and the trend goes into a negative territory, losing market share. I leave it there. I don't have an answer, but I think again that this strategic autonomy will play a role.
Thank you very much, Antonio, for emphasizing what is really a very important point, and certainly high up in the institutions' reflections this day, also in light of the war in Ukraine, obviously, and geostrategic tensions with China. So we are perfectly on time at 4:30, but before concluding, I want to hand back the floor to Christy Petit, because she has been authoring the report by the European Parliament that prompted this whole event. And so I think it's only fair that she has the last word, not least because she also brought gender balance and color to this panel. So I think, Christy, if you could take 2 or 3 minutes to bring together some of the thoughts you had on this in light of the comments and questions, and maybe wrap up, and then I shall already announce there is a coffee break and drinks for those of you who are able to stay longer and continue the conversation in a more friendly and informal way. And thank you all for being with us this afternoon. Christy, the floor is yours.
Well, thanks very much, Federico. Now, I will not be so long. I think some of you may have also questions and some debates to continue over the drinks afterwards. I think it was a very interesting debate, very interesting discussion with different perspectives, still very much in flux, to move, right? I mean, on both sides, we have huge files on the table for banking regulations, for capital markets union, for sustainable finance, digital finance, and so on and so forth, just to name a few. I would say, I mean, the mood is more and more positive. I mean, imagine that this report was written over autumn and winter, delivered in end of January, and then so the Windsor framework happened, and then the MOU last week. So we are on the good move, right? Observing these trends is fascinating. It's fascinating also to speak with other people from other jurisdictions. It's also fascinating to think about the needs of different stakeholders, of course. Sort of also, I mean, some keywords were not so much mentioned. I was a bit surprised. So sort of legal certainty, you know, predictability. So sort of, which is a bit at odds sometimes when you want, when you're looking at some of these regimes that are very unpredictable. This was said, unpredictability. But I would say, I mean, we need to speak across the channel. So I think I will have some follow-up points looking more at the details because you asked specific example as to where we could see equivalence happening. This is very difficult to say, but I mean, in the report we have outlined some proposals for this, but then of course it's also talking with the businesses themselves and then looking at how this financial services sector regulation is evolving in the UK. I mean, probably some of you're following this very closely, so the FCA is uploading this regulatory grid every semester or quarter. This is highly informative, but then, you know, it's like a 50-page long where you see like the consultation process, it's policy papers. I mean, you need to navigate through all this and then understand what it means concretely, because, I mean, it's also about maybe perhaps changing slightly the laws, changing slightly the wording from retained EU law or the law that used to be there. But then if the outcome is the same, at the end of the day, are we really diverging? I don't think so. So there, I think we may reconcile, and maybe, I mean, I will, of course, that's my job as part of academia, to try to think a little bit, put this into broader framework, try to rephrase, or maybe find some more positive wording, because divergence, indeed, as Massimo said earlier, it has been coined as something quite negative, so sort of, I mean, negative for the perspective of cooperation and sort of cross-border businesses. But then it was very much political rhetoric. So maybe we can see a little bit how it's moving forward. And, well, happy to discuss further over a drink, because I don't want to bore you more. But please do read the report and get in touch if you have further discussions. I'm always happy to have Zoom calls, or if I'm in Brussels, to meet up with you. Thanks very much. And thanks very much to Antonio, Federico, Massimo, and Andreas. I was very happy to have this roundtable with you.
Thank you. It is in my reading list.
Perfect.
Thank you.
Thank you, Christine. Very good.
Yes?
It is in my on my reading topics.
Okay, well, you should. I mean,
Well,
then,
in fact, I have started to read it. Look.
You have some
let me show
highlight.
Exactly. Let me show.
Yeah. Well, no, I trust you. But you know, I think in 6 months I need to write another report. I need to ask the ECON Committee,
maybe the
or
EC
you,
asks us
if
to
you
do
commission some studies.
Well, we don't have budget for that.
Well.
But no, obviously that is going to be a piece, a very important piece to follow.
Yeah.
I think that was really good, the MOU.